Welcome back to the Deep Dive. Today, we're jumping right into a fascinating story of corporate strategy and really resilience.
Definite resilience. That's the key word here.
We are dissecting the opening remarks from Lovesac CEO Shawn Nelson during their Q2 fiscal 2026 earnings call.
And this is so interesting because if you follow the home category at all, you know it's been under pressure for years.
A huge amount of pressure.
Yeah, so for a company in that space, especially high-ticket items, to be growing at all, it becomes this really crucial case study in how to navigate a tough market.
Okay, so let's unpack that right away.
Yeah.
What was the headline number from Q2 that really signals that are outperforming?
Well, the top-line performance is really a big story. They reported results that were in line with or slightly favorable to what they were expecting.
Which in this economy is a win by itself.
It's a huge win. Total net sales for the quarter came in at $160.5 million. And critically, that was up 2.5% year over year.
Okay, so 2.5%. I mean, it sounds modest, but you're saying the context is everything?
The context is where it gets spectacular. Because management estimates that the entire furniture and home goods category, it actually declined by about 4% in that same period.
Wow. So, wait, if the market shrinks by 4% and you grow by 2.5%?
You're not just growing, you are actively taking market share from your competitors, and at a really impressive clip.
That's a 6.5-point swing between them and the industry average. That's huge. They're not just waiting for the tide to lift them.
Not at all. And the CEO made that very clear. They're not just sitting around waiting for the housing market to magically recover. They're investing.
But investing responsibly, it sounds like.
Exactly. He talked a lot about controlling expenses, but at the same time, protecting what he called their significant investments in innovation. They're staying profitable, they have a healthy balance sheet. It's all about strengthening the foundation while everyone else is, pulling back.
Speaking of foundations, this leads us right into this strategic metaphor he's been using, right? The oak tree.
The oak tree analogy, yeah. He first brought it up at their investor day.
So what's the thinking there? Why an oak tree?
It's just a brilliant way to frame a long-term vision. An oak tree is wide, it's strong, durable, and it takes time to grow.
Okay, that makes sense.
So right now, the world mostly just sees a couple of the main branches.
The Sactionals and the Sacs, their core products.
Right. But the promise, the strategic vision, is all these new branches over the next coming years. And he's not just talking about new pillows, he's talking about entire new rooms of the home.
So this isn't about radical, risky expansion next quarter. It's about slow, deliberate, structural growth.
Precisely. And that's where this whole brand evolution refresh they're doing comes in. It's not just changing a logo, it's about shifting from being a company that sells couches
To becoming a true home brand.
a true brand with a clear hierarchy and a story that goes beyond just one product.
But if they have these huge ambitions for new rooms of the house, why is the focus so intensely on the core right now? I mean, he said radical growth is still more than a year away. Aren't they risking missing the market turn?
I think that's the strategic trade-off they're consciously making. It comes down to profitable growth. The fastest, most credible way to grow profitably right now is to maximize what they already have.
So harvest the equity they've already built.
That's the exact phrase they used, harvesting Lovesac brand equity. Earn margin from existing markets before you take these huge, expensive leaps into brand new categories. They want the trunk of that oak tree to be unshakable before it supports those huge new limbs.
That's smart risk management, especially now. You fortify what you know works before you risk capital on the unknown.
Exactly. And that brings us perfectly to the first tangible result of all this. The launch of Snug by Lovesac.
Right, this is the first new branch to be officially named.
Well, it's a rebranding of a product they called the Ever Couch, but by calling it Snug by Lovesac, they're slotting it right into that new brand hierarchy. It's a very deliberate move.
So tell us about the product itself. How does Snug fit in with their flagship Sactionals?
It delivers all those core Lovesac benefits people love, It's washable, it's upgradable, it ships in a box.
All the key selling points.
All the key points, but, and this is the key, it's in a bit smaller package that can always fit any space. It takes the complexity of the Sactional system and just simplifies it.
So it lowers the barrier to entry. Not just on price, maybe, but also on complexity. Less intimidating for a new customer.
Absolutely. And the rollout is aggressive. New advertising just went live, and it's already in 100 of their physical locations. This is a full-on commitment.
The CEO also used this launch to sort of restate their ambition, didn't he? He mentioned being ranked 19th on some list of home retailers.
Yeah, but he was very clear. He said, our ambition is to be much larger than that.
And Snug is a key part of that.
It has to be. A product like Snug opens up their total addressable market in a huge way. Think apartments, smaller living rooms, second homes. It's a massive investment in their future reach.
So we have this really aggressive, forward-looking strategy, the Snug launch, the whole oak tree vision. But then the CEO's tone shifted pretty quickly to the harsh realities of right now.
He had to, and he was very candid about it. He said there's only been a very slight improvement in the overall furniture category. Spend was still down 3.7% from May to July.
So they're planning for the downturn to continue.
Yeah, their baseline assumption for the whole year is that the category will decline in the mid-single digits. They're planning for the worst while executing for the best.
And what were those two specific things that forced them to lower their margin outlook? This is the critical financial piece.
He pointed to two factors that were, in his words, more punitive than they expected. First was the tariff situation.
Right, but it wasn't just existing tariffs, was it? It sounded more complex.
It is. So you know how everyone's been moving their supply chains out of China to avoid tariffs?
Sure, to places like Vietnam or Malaysia.
Exactly. Well, suddenly the reciprocal tariff rates from those countries started changing. So the strategy they were using to avoid the tariffs suddenly got more expensive.
Wow, so their solution became a new problem. That's a logistical nightmare.
A huge one. And the second pressure was just continued, aggressive discounting from competitors across the entire market.
So it's a classic margin squeeze. Costs are going up on one side because of tariffs, and prices are being pushed down on the other because of competition.
Squeezed from both ends. That's a perfect way to put it.
So how are they fighting back right now? What are the immediate, controllable steps they're taking?
Well, they're not just sitting on their hands. They did some select price increases early in the third quarter to offset some of those costs.
Okay.
And at the same time, they're just intensely managing every controllable expense they can, really tightening the belt without touching those core innovation investments we talked about.
But he did talk about a path back to their stronger margins, right? He didn't frame this as a permanent problem.
No, definitely a longer view. He stressed that they've already identified measures that should start helping gross margins later this year, in Q4, and then more over the next few quarters.
So the goal is still getting back to that, what was it, high 50s, near 60% gross margin.
That's the long-term structural goal for the brand, yeah.
Yeah.
And they believe it's still achievable. It just requires a ton of execution on optimizing that global supply chain, which, takes time.
It's not a quick fix. It's a multi-quarter operational project.
For sure. But it shows they see this as a temporary storm to weather, not a permanent flaw in the business model.
So if we pull all this together, what does it mean for the big picture? The CEO ended by really reinforcing that they're committed to growing no matter what the market is doing.
Right. The core objective is still the same. They want to serve 3 million Lovesac households by 2030 and build, as they see it, the most loved home brand in America. Everything they're doing, Snug, the brand evolution, it's all a step toward that 2030 goal.
And they have this conviction about the market eventually recovering, the when not if strategy, they call it.
Exactly. They are not sitting around waiting. The CEO's point is that this whole time, a massive reservoir of demand is building up. People are delaying replacing their couches.
So when the housing market finally turns over,
Which he added is one day closer than it was yesterday, they want to be in the perfect position to capitalize immediately. And because they've built all this efficiency during the lean years, that new revenue will flow right through to the bottom line.
it's a really compelling case for investing when others are retreating. He really drove that home.
He did. And then just before handing off the call, he took a very thoughtful moment of silence to remember the victims and survivors of 9/11. It was a powerful way to reinforce the company's values.
It really was. Okay, so to recap this deep dive, we've looked at how Lovesac is pushing for strategic growth with things like the Snug launch and the brand evolution.
While simultaneously fighting off these major macro headwinds like tariffs and a declining category.
So they're gaining share, but it's a complex, disciplined fight.
I think the key takeaway here for you, the listener, is this commitment to long-term structural investment. This is a company choosing to build that durable oak tree, even if it means taking a hit on profitability in the short term. They're focused on what they can build, not just reacting to the noise.
That brings me to a final thought. The CEO hinted that the simplicity of Snug, the fact that it's smaller, more shippable, easier to understand, unlocks new channel opportunities because it doesn't need as much in-person demonstration as a Sactional.
That's a really interesting point.
So here's something to mull over. If Snug is that much simpler, What kind of unexpected partnerships or retail placements could that unlock in the next year? Are we talking about mass retail, smaller, non-traditional showrooms? It really opens up the possibilities for where this brand could show up next. Thank you for joining us for this deep dive into Lovesac's strategic roadmap. We'll see you next time.